This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Don Pelgrim, Chief Executive Officer of Wilshire Finance Partners Incorporated. And we're going to be digging into some stuff. We don't always necessarily cover things that blend extremely well or are kind of a direct avenue to what we do professionally as alternative asset custodians and self-directed IRA administrators. But today's a little bit different. We are going to be kind of covering something that does have kind of a direct corollary effect to things that play very well with that, while also kind of bringing in a lot of good information. We're going to be covering things like private credit. We're going to be covering things such as trust deed investing and the different ways that do, and kind of the broader alternative market as well. So Don, thank you very much for being on with us today. Very pleased to have you on. If you wouldn't mind, give us a little bit of background about yourself, kind of how your professional trajectory kind of landed you on our doorstep to be on the podcast today.
Sure. Well, thank you for having me, Alex. I appreciate it. As you mentioned, I'm the CEO of Wilshire Finance Partners. I'm also a fund manager at Wilshire, and we'll get into that a little bit later. My background and my experience, I'm actually an attorney. I practiced real estate and corporate law, and also a banker. So in my career, I've been either representing banks as an attorney or inside banks, running banks. So my background is very steeped in real estate lending. Wilshire Finance Partners is a real estate finance and investment company. And as we'll discuss, we're very deep into real estate lending and investments.
Fantastic. So, let's kind of start from the beginning of, let's take a look at like what the market's looking at, currently, and kind of how some of those problems are being solved by at least investors in your space. I know everyone kind of likes to pick on, the fact that, money's expensive. And, if you're in the single family market, well, certainly it is, but you have to have a roof to put over your head. If you're doing that as kind of a boots on the ground to go out and build a rental portfolio, yeah, things are tight. But where it really starts to kind of look at it at a broader sense and really understand the mechanics of the market is when you start looking at commercial real estate and how debt is affecting those asset classes. So from a lending standpoint or being on the money side of things, let's talk about kind of current market analysis, if you wouldn't mind just giving like a brief recap of kind of what you're seeing and what we might need to prepare for going into the next, towards the end of the year and into the next year as well.
Sure, that's fair enough. Well, I'm going to date myself here, but when I started in the marketplace, interest rates were in the teens. So, where we are today is not too terrible. But broadly, what we're seeing in the marketplace is that when interest rates really spiked through the raises that the Fed were really governing, we saw a differential or a gap between the bid and the ask, between what buyers and sellers are willing to pay for properties and what people were willing to sell properties for. And I think that gap has now narrowed a little bit as people have started to realize that interest rates are going to be higher for longer. With respect to different asset classes, those asset classes are being impacted a little differently depending on the type of asset class it is. You mentioned single family homes, and in single family, we've had a very, very nice run in terms of demand for single family homes. Some of that was, I think, a fundamental shift in how people were using their homes and where they were able to live coming out of the pandemic. There was a slowdown because of interest rates. But when we start to look at other asset classes like commercial real estate and the individual asset classes under commercial real estate, because that's really an umbrella term, there are certain assets that are in demand and are showing a lot of resiliency for various different reasons. So, for example, if we look at warehouse and industrial properties, the driver there for many, many years was e-commerce and the distribution system. And there was this last mile theory where years ago, if you bought something online from Amazon, you would get it in a couple of days and you were very happy. Roll forward a couple of years, and if you got it overnight, you were very happy. Now you're looking and expecting to get it the same day, which means that the distribution network has to get closer to that end user of that product, which creates demand for those warehouse facilities. So when we looked at that particular impact on the market, and now we look at the push for onshoring of certain key elements for the U.S. economy, there's that continuing demand. Pivoting to other asset classes, there are asset classes that are needs-based real estate. So, for example, we're very active in the senior housing space, assisted living facilities, memory care facilities, so on and so forth. And when you stop and think about it for a moment, that's the type of real estate where if somebody has, for example, Alzheimer's or dementia or needs help with their daily living activities, there's a need for that type of real estate. And we're now in an aging population, and there's growing demand for that type of real estate. So when you look at the different asset classes and you look at the different real estate types, you're going to see different things that positively or negatively affect each one of those different asset classes.
Now, as it relates to the, the price ratio between, the money that you're coming in and then the revenues that are coming out of something, would it be fair to say that those two asset classes can absorb a greater amount of, price differential for that? Meaning that, it's easier to, raise the commercial rents on warehousing and light industrial, and then also, bake that in as well to assisted living, because you have buffers such as people with insurance. And typically you're dealing with people that, it's going to be like, hey, my last check's going to bounce and I need to have somewhere to live, as opposed to asset classes maybe in the middle where, commercial multifamily, you can't necessarily just pass on that buck to the end user. So your cap rates are getting compressed. Is there something that kind of you would say is relatively ancillary to the price of money, to the utilization and the asset classes in commercial real estate at the moment?
Sure. I think that when you start to think of things like assisted living facilities, they have different pressure points, just like other commercial real estate would have different pressure points. So, for example, when you think of an assisted living facility, you've got an operating business there. It's not just heads and beds, so to speak, like you would have in a multifamily property. You're providing care and you're feeding the individuals. So there are different costs that are going to be impacted by that. One of the major expenses was staffing, right? As wages go up, you've got this pressure on net profitability because of the increase in wages. But I think that when people go back to their loved ones, the people that are assisting mom or dad or grandpa in that facility, they recognize that there is this upward price demand and price pressure. So you're right. Some of that has been successfully passed along in a higher rate that's being charged in those facilities. And the logic behind that is that you want to maintain a certain level of care. So the ability to pass that on is maybe a little bit easier in that type of asset class, as opposed to maybe somebody that is in that studio apartment and has a certain level of income, and how high is high on that studio apartment. Same thing with some of the other asset classes that you mentioned, where there might be the ability to absorb higher costs associated with that real estate in that warehouse or that industrial property because of the demand for that, and the ability for that business to go ahead and cover that additional increase in operating expenses. Again, other needs-based real estate, for example, if you've got a self-storage facility in an urban environment, we all have way too much stuff, right? So all of us are, packing these storage facilities with different things, and the demand for that continues to increase. So you might be able to pass along some of the increases that you might have with your utility and other expenses to the people that are renting those facilities. So you're right. I think you're right on there with you thinking that depending on the asset class, you'll have a little bit more resiliency to economic changes.
Yeah, and I think it also, especially with the thing I always find a little bit interesting about self-storage, because I get asked this anecdotally and professionally. It's like, well, why is this so interesting? I'm like, well, you have kind of an asset class that basically has maybe a direct, like it's an inverse correlation. When things are going a little bit worse and people are needing to downsize and save money, the asset class is going to do better. But people rarely are ever going to then in turn withdraw out of that. At least from the operators that I've talked to. I mean, case in point, my parents if I've been out of the house now for almost 18 years, and they just now got rid of their storage unit. I mean, they have like a 3,000 square foot house. Like, they have room to put the stuff back in there. But I hear that from a lot of operators, is that they have very low turnover once they tool them up. If there's a repositioning, there's very kind of low turnover, and they see a lot more increase in business when, the economy might be slowing down, things are getting more expensive. So it's just one thing I've always found interesting talking to those operators. And again, the ability to absorb that additional cost, at least on the front end of your money being more expensive, it's a lot easier to kind of raise the rents a few, however, whatever your incremental price difference is, it's a little bit easier to do that and pass the buck a bit. So, again, I think it's definitely kind of a good look at it. And I do kind of agree that, I like to, always think of myself as a student of history, and, looking back to the 80s when we see, 13% interest rates, I don't think that's necessarily sustainable. And it certainly wasn't, as history has told us. And then also coming into an era when we have more or less free money. You can't really sustain an economy with having money that's being lent out at 2 and 3%. I think it's a little bit more of a healthy equilibrium for the market as a whole for, to be charged and have that kind of, interest rate in the market. I think it keeps people from over consuming, which again kind of leads to some problems. Take that for what it's worth. Whatever your view on people, over consuming in the real estate realm, I'll leave that for another time. But again, I do feel it to be a little bit more of a healthy equilibrium, but it's going to take some adjustment. It happened pretty rapidly. You're talking over the span of being used to that kind of interest rate for the past 6 years or so, and then going in within the course of like 15 months, going from that to where we are now. It certainly is going to make things a lot more difficult, especially in the commercial real estate realm, where you have people, maybe they're doing a 5-year runoff on their plan with the plans of a refi, and now you're going to be underwater on your cap table just from the expense ratio on the money. So, it's certainly something to look at. And that's where I'm kind of interested to see what's going to happen. You have a lot of operators that, really could have done no wrong for the past 10 years, look like a genius investing in commercial real estate with very few, kind of checks and balances of, some healthy attrition in that market. Now it's going to be a lot harder to refi out of that. It was a lot easier to refi out of a bad deal up until maybe 2023. And now you're starting to see, some pressure be put on it. Do you see that as kind of a more of an opportunity from your standpoint to, people that are maybe in over a little bit over their skis, or some stuff that was financed and margins, assuming the money was going to be the same price? Where do you kind of see the opportunities coming up in the future for some of these things?
Yeah, I tend to agree with you. The old saying is, right, you know who's naked when the tide goes out, right? And, real estate is cyclical. And, when interest rates go up and you've got this increase in cap rates simultaneously, and your back is against the wall because you've got a loan that's coming due, you had a 3% interest rate, you were able to get a very high loan to value or a lot of leverage against that property. Well, guess what? It's a different environment today. So for some people that own those kind of properties, there's going to be stress. Conversely, people who are in the market looking to acquire, this might be a good time to acquire real estate. You might be able to see some buying opportunities. We as a lender are using this environment and looking for those acquisition opportunities. Who are the people that we can back with our capital that are going out there and acquiring these properties that might have an opportunistic component with them or a value add component associated with them, taking a little bit of a longer view that rates will probably moderate at some point, and that'll allow them to create value, but also exit from the loan that we're making a little bit more easily. So that translates into, I think, a better investment thesis for the people that are placing their capital with us in that private credit or those real estate loans.
Yeah, and that's kind of why I posed that transition, is that it's, I think the big opportunity here is, especially with the flux in the market as far as, the money side of the, commercial debt, it's called the institutional debt, is the opportunity for people, such as yourself and other operators to really focus in on the financing aspect of it, not necessarily the acquisition, which again is nice from, a volatile market of saying, hey, I'm not taking the headache or maybe the risk profile of actually owning it, but I have the security of, in theory, again, I always like to be careful when say controlling real estate, because if you're the lender, again, how much control do you really have? Depends on the loan structure, but again, being able to be involved and have asset based investing while not necessarily having to deal with the operation aspects of it. So with that said, what are some kind of key components that you are, enjoying and looking at least in the near term and then the longer term future of being more on the debt side of the equation in this?
Well, as a lender throughout my career, we always had a little bit of a different position in the real estate that we were involved in, right? So if I'm sitting in a first lien position, whether that's a mortgage or a deed of trust against a property, and let's say there is stress in the environment, as you pointed out, there's maybe an increase in cap rates, which is going to decrease property values, and you've got additional stress through increased borrowing costs. Well, if I'm sitting at a proper loan to value going in on that property, I have a protective equity cushion ahead of me, right? So, for example, if I'm lending at a 65% loan to value, and at the time I made the loan, a property was worth $1 million, that means I've got a $650,000 loan against that property. Fast forward a couple of years, if cap rates and interest rates are much higher, and that property is now worth $800,000, well, if I'm still holding $650,000 against that property, I still have a protective equity cushion there. So I don't have the same impact that an equity investor in real estate would have. But there's always trade-offs, right? I don't have the same upside that an equity investor in real estate would have either, right? I'm clipping a coupon as a lender. I'm receiving that interest, but I don't get to participate in that potential upside. So what I do is a little bit more conservative for the investor. It's designed to be a more stable source of income. It's designed to have some protective equity cushion or some downside risk protection for them. And the trade-off there is that while they're getting those types of protections, they're not, getting that potential upside in the real estate. So it's about balance. And for example, some people might have direct real estate investments, but they're still putting money into deeds of trust or a deed of trust fund like we've got, because they're hedging their bets a little bit by doing that.
Yeah, for sure. And that definitely makes sense. But one thing that I would is a kind of a low hanging fruit question though, is that, what really kind of makes it more attractive on the investor side to utilize private capital as opposed to institutional? I mean, now it's a little bit easier to kind of frame that out because it's a lot harder to get the money. But from your perspective also, especially with a more tumultuous market, what are some things that you look at to make sure that you have that loan to value cushion built in when you initially go to closing? Because again, if properties are getting more expensive, money's getting more expensive, it would wager to guess that the majority of the market is going to have less capital to put up. So you're not going to necessarily have as much built-in equity, in a deal. So how do you kind of navigate that, especially in today's market? What are some things that you look for?
Sure. Well, let's first talk about what's happening in the capital markets, right? So what we're seeing in today's environment is that the banks are not lending at the volume and the velocity and on the same terms that they had in the past. We're also seeing that the agencies, Fannie Mae, Freddie Mac, and HUD, have changed their parameters a little bit. And I'm talking about multifamily and other commercial real estate asset classes. So as a result of that, you also have longer timelines for people who are going out and looking for that capital. So what that means then is that private credit, or the credit that we put out in the marketplace, becomes more attractive. We're able to move a little bit more quickly. We're able to move with a little bit more flexibility. We have the capability to act more crisply, if you will, in order to get that capital out for that person that's acquiring that property. You're correct that how we need to look at the real estate is a little different, right? So how we look at the marketplace is at a couple of distinct points in time. That first point in time is, what are we lending against today? What does that property look like? What are the cash flows from that property? And does it have the capability to support our debt? Looking forward at the time where that property might be transitioning into permanent financing, we want to take a look at the cash flows that would be available at that point, and is there a viable exit through that longer term traditional financing? So when we're lending against a property, we're trying to underwrite it in a way that we're comfortable with it today, but we also have viability for the repayment of that loan that we've made later. So that's how we approach the marketplace. We also keep our loans very, very short. Right now in my fund, the weighted average maturity is about 24 months, or about 2 years. And we've got a staggered or a laddered portfolio of loans. So not all the loans mature at the same time. They'll mature at different points in time. So what that enables me to do is manage that portfolio in a very dynamic way. I can look at what's going on in the marketplace, what's happening with property values, and I can adjust in real time how we're managing that loan portfolio. And that helps to reduce overall risk as a lender.
Yeah, no, I mean, and the nice thing is with debt, on the level that you're doing it, it's not the most complicated thing to kind of understand. Execution is certainly not the easiest thing in the world, but I like things that, especially for our listeners, can be distilled down as something that's easy enough to understand. It's like saying, okay, well, if there is friction in one market, we aim to solve that by X, Y, and Z. We're going to look at this asset by saying, hey, are we going to be okay with this if the markets continue to get worse? And then we're going to have something that can service the debt in a more long-term fashion. Again, the high level concepts are there, and that's one reason I personally really like debt from an investment standpoint. You give up that upside risk, but investing for long term cash flow, again, is something that always makes me sleep good at night. If you're always sleeping hoping that something's going to happen to make your money, as opposed to going to bed at night and sleeping and saying, hey, you know what, tomorrow's another day and everything's going to continue exactly as I have planned it and set it up to do so. And you really can't do that with anything that is banking on tomorrow's price of something. It just doesn't necessarily work like that.
Absolutely true. And I think that there's, when you think about lending and investing in private credit or mortgages, deeds of trust, what's the primary risk that you're going to face as a lender? Well, it's non-payment, right? It's the risk of default. So as a lender, there's really a couple of key concepts. One is, how do you mitigate that risk, and how do you mitigate the probability of default, or the likelihood that a default is going to occur? The second risk is closely related, but a little bit different, and that is, what is my loss exposure should a default occur? Getting to your point, right? So one of the ways that you're able to mitigate that risk is by having a moderate loan to value. Because if you have a moderate loan to value on a property, guess what? The borrower has skin in the game. They have something to lose. And if you go back to the financial downturn in 2007 through about 2009, you saw a lot of people walking away from properties because they were underwater. But if they had equity in that property, they had something to lose, that reduces the probability that they're going to walk away from that property. In other words, by hook or crook, they're going to try to figure out a way to pay you off. So that reduces the probability of having a problem in the portfolio. By also having that lower loan to value and also having that equity cushion, you reduce your loss exposure, right? Because I've got that buffer, I've got that additional equity ahead of my loan that helps protect my principal investment in that transaction. So by having a moderate loan to value, I'm able to actually tackle both of those risks pretty well. We can get into it in another day, but there's some other things that are behind that. You want to make sure that you're at the right loan to value, and you're looking at value in a certain way, because there's different ways to value a property. You can, getting to your point, look at future value, or you can look at today's value. And you'd have to consider in both of those instances what the potential impacts might be on those values.
How heavily do you weight the the property's like net cash flow receipts to that? Does that play a big factor, and especially in commercial real estate? Would you say, like, in the stack of saying, okay, the loan to value being kind of up here, which forces them to have skin in the game. But where would you say like the, the where you look at the property's ability to repay as it weights to the individual's ability to service the debt?
Sure. And that's sort of the five C's of credit, right? And the five C's of credit are, I'm going to be looking at an individual's credit. I'm going to be looking at their character. I'll look at their capacity or their ability to repay the loan outside of the real estate itself. I'll look at the cash flow from the property, and you look at the collateral value. And a traditional lender will provide a weighting on each of those factors, and sometimes might rely more on a borrower's capacity or the ability to repay separate and apart from the cash flow of the property. Okay. Sounds all and well and good, and you've got somebody with a great credit report, but think of it this way. If somebody steps off a curb and gets hit by a bus, well, you've lost that great credit and you've also lost that capacity. So the way that we look at things is, we want to make sure that the cash flow from the property itself has the capability to support the debt payments. And getting to your point of capitalization rates tie directly to the cash flow from the property, and by virtue of that, also the valuation of the property.
Yep, and that's go ahead.
So cash flow and valuation go hand in hand, and that's something that we look at very, very heavily. We want to understand that. We want to make sure that not only is it consistent cash flow, but the quality of that cash flow.
Sure. And that's one reason that, personally, I like the commercial debt space, because there's a lot more of granted, there's more commas and more zeros in the loans that are being made, and the price and the barrier to entry may be a little bit higher for people. And that's, again, kind of the transition I want to make into kind of what you do with what you do and some of the differences there. But the much greater ability of commercial real estate to absorb market fluctuations as opposed to just lending on single family real estate, especially if you're doing it directly. You lose one tenant in commercial real estate. Okay, great. You have a built-in buffer of, 100 other doors that are there to cover that carrying cost of a vacancy, as opposed to you lending on one property. Again, depending on what your loan to value looks like and who the borrower was, now that property can no longer service that debt, and the person now has to service that debt. So, one thing that I like about commercial real estate is the inherent buffers that are built in from a bunch of different angles. The value of the property can go down, rents can, remain relatively static. You have the ability to absorb vacancies. You can't absorb 20% vacancies, but you can certainly have the ability to, absorb some turnover. But it comes with this other set of risks. You have management costs. You have the, ability, you have to manage your organization, because typically you're not just doing it by yourself. It's run through some type of business organization, maybe a limited to general partnership structure, managing investors. So again, there's trade-offs for everything. But again, the big thing I like about the commercial debt space really is that ability to, again, be a little bit more fluid with market conditions, if you will. So go ahead.
Yeah, I agree with you, and I think that I'm gonna poke a little hole in that. And I think that when people are investing in any asset class, whether that is a single family home or a duplex or whatever it may be, as well as commercial real estate, I think they have to really look at that asset class and the individual asset. Real estate is really it's kicking the dirt. Right, it's understanding what you're lending or what you're investing in. So for example, if we were to take commercial real estate and paint it with a very, very broad brush, I think there are certain segments in commercial real estate that have stressed and may have fundamental changes that have impacted them. And I'm thinking of office, for example, right? Office nationally is
the big question mark.
Yeah, you've got 20% vacancy nationwide, and you've got certain cities where I don't know if they're necessarily going to fully recover to where they were pre-pandemic. So, for us, we don't lend in that particular space for those particular reasons. Conversely, I look at again, I'm going to pick on seniors housing because it's easy to do. You've got needs-based real estate. You've got growing demand for that particular asset class, and historically, through various different downturns, it's performed very, very well. It's been very resilient in terms of its cash flows and its valuation. You had a little bit of a blip in COVID, but it came back very, very quickly as well. So in that particular asset class, I juxtaposed that to office. And if I'm forced to take a position on something, I'm going to go into seniors housing and not into office. And I think you can do that with different asset classes. I think that it's like managing your investment portfolio. There's going to be certain investments that you're going to make today that make sense today. And then rolling forward, you might need to make adjustments to your portfolio over time based on new information or changes to the marketplace that require you to make, those adjustments. And that's where I think keeping things short on lending, real estate lending, it gives you, again, that capability to do that and manage your investments a little bit more in real time and pivot and make adjustments when you need to.
Yeah, and I think the banks kind of have that, long term, the 20, 30-year debt kind of market cornered. You have to have the economy of scale to kind of eat, making 5% a year over year over year to really kind of do that. It's not that, you have to be a lot more nimble. And that's, again, where kind of someone like yourself really comes into play by having that, ability to the velocity of change that you can accomplish, right? Being that nimble and being able to adjust to markets instead of having, a huge org stack that you have to go up and then up and down to say, okay, now we're going to change our lending standards.
Well,
but
sure.
Yeah.
What's interesting about it, when we think about cap rates, right? So depending on what it is, where it is, and the attributes of a particular property, we're still seeing cap rates that are in the fives and the sixes. Conversely, if I'm delivering now in my fund close to 7.75% net to my investors, and they've got a protective equity cushion ahead of them, I've been able to maintain a stable net asset value for 10 years. It hasn't changed. Sort of like a supercharged money market account, obviously not a money market account, but using that as an analogy. Do I want that market risk? Do I want that risk of putting my equity capital into a piece of real estate at a 5 cap when I can clip a coupon at 7.75%? So, we're seeing investors look at it from that point of view as well. And again, going into a fund like ours or going into a trusted investment, this is not something that you're fully locked into, right? It's not like you're making, as you pointed out, a 30-year commitment there. You're making a shorter term commitment or having a shorter investment horizon in that type of investment. And in today's environment, it may make more sense to look at private credit or private debt as opposed to that direct equity investment for all the reasons that we've just talked about, right? The dynamics in the marketplace, the higher rates, capitalization rates not keeping up with what's going on with the interest rate environment, and some of the opportunistic lending that's out there as well.
Yeah, absolutely. And I think that's kind of a good point to transition into, some of the nuts and bolts of, the reasons why you do what you do and kind of how you frame that to your investors. We had, kind of danced around it a little bit, but, the difference in kind of, doing this, directly because, people listening to this, come in and say, oh, that's great. Well, unless you have, that many millions of dollars sitting around to lend on commercial real estate, it's a tough barrier to entry. So most of the time people are going to say, okay, well, maybe I'll start at single family. And, as illustrated, that can be problematic, especially if you're going to be doing long term or if you're going to be doing shorter term. You're much more at the mercy of the markets and how they operate. So, at least with what you try to accomplish with how you set things up with being able to invest through a fund and then kind of how your fund breaks it down into, what it does, let's kind of examine that for a minute because I always find that really interesting. It's good to talk about theory and high level stuff, but I always like to understand how, guest, where does the rubber meet the road? When it gets to putting it on the pavement, how do you like to go out and deploy investors' capital?
Sure. Well, I think that we have to start with the underlying asset, which is a mortgage or a deed of trust. And an individual investor can invest in a mortgage or a deed of trust directly. And they can do that through non-qualified money or through their self-directed IRA plan. That's, perfectly fine. Getting to your point, depending on the size of the loan, they may be able to acquire 100% of that loan and be the owner of that particular loan outright. But more often than not, even with single family, you've got hundreds of thousands of dollars, which are the loan dollars that are being put out to the borrower. And an investor may want to only invest $100,000 or something less than what that full loan amount is. So oftentimes they'll co-invest with other investors in a particular loan. And you'll hear things like fractionalized investing or fractionalized deeds of trust. It's really those investors going side by side and each owning a pro rata share of that individual loan. Now, the value of investing in individual loans like that is that you have the capability to self-select that loan. It's a very active type of investment. And so you might have somebody who is, maybe they know about real estate and that particular loan opportunity is in their backyard. They have the capability to drive past the property and understand the dynamics of it. And maybe they have the capability to take a look at the economics that the lender was using when writing that loan. And they're able to make that choice of investing in that loan. Terrific. They've now self-selected that loan. It's a very active investment for them. The challenge with that, though, is that they've got a concentration of risk in a single loan, right? So if that loan goes sideways, then they, alongside the other investors, if they've co-invested, have the same level of risk or a pro rata share of that risk in that single loan. We pivoted and we created a fund. And some of the benefits of going into a fund is, number one, you've got hopefully a fund manager, and I think I'm a pretty good fund manager, and I think I've got the bona fides to understand lending and to lend properly. And you're then taking those individual deeds of trust or those individual loans, and those become the building blocks within the fund. And if you do it properly, you're creating a diversified portfolio so that when an investor goes into that fund, they have a pro rata share of each of the loans in the fund, and you're diversifying their risk exposure across asset classes, geographic locations, borrowers, loan terms, duration, a variety of different things, which helps to mitigate the overall risk for them. The investors in our fund in particular, we have a minimum investment of $100,000. So it's not like they would have to invest in a commercial real estate loan by putting down $4 or $5 or $6 million. By investing $100,000 in our fund, they're diversified across all the different types of loans that we've got in the fund and all the different asset classes that we've got in the fund through that investment. So that's a big differentiator. The other differentiator is that it's more of a passive investment, right? You're hiring that professional fund manager to manage those loans and take care of those loans on your behalf, and in that dynamic portfolio management that we talked about. So again, a little bit of a different investment than investing in those individual loans. One of the trade-offs in investing in an individual loan as well is that when you put your money into that loan, you don't have the ability to call it back, right? Unless that borrower goes into default, then you have the capability to go through foreclosure. But until they repay you, you've made a commitment to allow them to use that capital until the maturity date of the loan. Conversely, if you go into a fund, that becomes less relevant. We have what we call an evergreen fund, which means that investors can come into the fund, investors can redeem from the fund, loans are made in the fund, loans get repaid, and we redeploy that capital into new loans. So it's very bank-like in that dynamic, right? You've got investors coming in, investors going out, loans being made, loans being repaid. And all of that creates internal liquidity within the fund inherently, which means that an investor would have the capability to redeem, notwithstanding the fact that a particular loan was not maturing just yet. So that creates a little bit of a different dynamic for that investor. So they're able to diversify the risks. They're able to create a little bit more liquidity. Another point that probably is near and dear to your heart too is that through a fund, if I've made a $100,000 investment, I have the ability to reinvest dividends and create compound interest, right? So imagine if I'm able to create compound interest and do that inside of a self-directed IRA, right? As opposed to an individual trustee investment where I'm getting a fraction of that interest every month and it's insufficient for me to reinvest in that same asset class. So again, there's trade-offs. There's a little bit more control in owning or directly investing in individual trustees. Conversely, there's some benefits of going into a dynamic fund like the one that we operate.
Yeah, absolutely. And one of the benefits and kind of lost on the IRA investors, and I'm always curious to know because these funds can be set up a multitude of different ways, but investing direct and like the direct deployment of capital, your returns are typically paid as interest on a particular investment, whereas with funds, they can vary a lot. It's going to be paid out in the determination on when you receive K1 can vary widely. Again, it really all depends on kind of the inherent operations of that fund as to how it's paid out. Now, again, IRAs is kind of a moot point, and especially if you're investing into a vehicle that is going out and lending and not acquiring debt, so you are on the issuance side and not the recipient side, is sometimes can be problematic with things like unrelated debt finance, income tax, or UDFI and IRAs. Being on the debt side of things again offers some additional flexibility and opportunity there. But what are some of the ways again that how are things, at least using yours as an example, how are these paid out to investors? And also kind of a tack on question is, are the returns that are paid to investors, do they have the ability to like what causes the fluctuation? Would it be market bear, like what the market would bear for interest? How many loans are turning over? What kind of are the drivers that drive the return? So how are returns paid, and then also what drives the rate of return, if you will?
Sure. So the way that our fund is structured is that we pay distributions on a monthly basis. So when an investor comes in the fund, they come into the fund on the first day of each month, and they would start to receive their distributions on the first day of the following month. And if you think about it for a moment, that's how mortgages get paid, right? People are paying their mortgages every month. So we collect that interest income, and then we do a distribution out to the investors. And in our fund, investors have the election to either receive that distribution in cash, or as we said, they can go ahead and reinvest that into additional fund shares, and that creates that compounding effect. And we're flexible enough that investors can even split that if they want a partial reinvestment and a partial distribution, or if they originally elect to reinvest and then want a distribution, which happens sometimes in IRAs, right, where they now have these mandatory payouts that they need to have. They can have that paid out from the fund on a monthly basis. So it's fairly flexible from that standpoint. When we talk about a dynamic portfolio versus a static pool, which is a self-liquidating pool, and I'm going to use the example of an RMBS or a CMBS security, right? When a commercial mortgage-backed security is created, you create this pool of loans, which then gets securitized. And you as a bondholder are going to hold a particular type of bond, whether that's going to be a principal and interest payment, an interest-only payment, a principal payment, whatever that may be, right? But that's a self-liquidating pool, and that pool is static. And the returns on that pool are really tied to the interest rates on the underlying loans that might be in that pool. So let's say you've got a fixed rate pool of loans, that's going to be your rate, okay? Conversely, in a fund like ours, again, being a little bit more bank-like where loans can pay off and new loans are made, we're going to trail up interest rates as interest rates go up because the market environment is now commanding a higher rate for our money. We have the capability to capture that. We also are going to trail down rates as loans go down, as interest rates go down, because we'll have repayments over a period of time. And one of the ways that we can manage that as a fund manager is that we can create adjustable rate loans with a floor. So for example, if I'm lending money, just pick a number 10%, and I put a floor of 10% in that loan, but I can capture the upside if interest rates go up again. What I've done there is I've sort of locked in a particular return on that loan, at least until it matures or until they pay me off. So the dynamic in our portfolio, getting to your point, is going to be based on the underlying loans in the pool and the coupons or the interest rates on those underlying loans. So as loans pay off and new loans are made in a rising interest rate environment, that interest rate will go up. In a declining interest rate environment, that interest rate will trail down. Okay. Now, I do have to point out that the fund is not correlated to the stock or bond market. So, for example, if you take that CMBS security, and that's a publicly traded security, you're going to be subject to market risk if the market for that particular bond is up or down and you need to sell at that particular point in time. You're going to have market exposure, and you might have a recapture your principal plus a gain, or you might lose money just based on the market fluctuation, not the underlying fundamentals of the investment itself. The investment itself might be perfectly fine, but that market fluctuation is going to cause risk to your principal. Conversely, in a fund like ours, it's a private placement, so it's not publicly traded, which means that we don't have market risk.
Yeah,
So
market risk in the sense that it's not, it's, something happens halfway across the globe and the entire U.S. stock market starts to ripple. Again, just so we're kind of clear on that, there with any investment, there's risk. There's no such thing as a guarantee. It does not matter what you do. There's inherent risk. But just again, it's a good point to make, and that's again one reason why I've enjoyed so much what I've done with my career over the past, going into my 13th year now. Of not dealing in the stock market and getting to see how alternatives, and it always pains me to say real estate is an alternative because the Romans were conquering real estate, they weren't buying Microsoft. It's again not the greatest term, but until they have something better, it's an alternative. But seeing really how they can perform, especially with markets doing what they do and economies going and fluctuating and things happening. Now, one thing you mentioned I really thought was interesting, and we are kind of getting towards the end of it, but you mentioned adjustable rate loans. And again, that's probably something that's not, it's not what you do across the entire board. It has to be kind of use case specific on what you're underwriting for. But you said there would typically be, a bottom, to help, prevent, your balance sheets from dropping off. Say, hey, here's the minimum you're ever going to pay for it. But conversely, is there any, and again, if there is or isn't, is there any type of upside protection for the borrower in that to say, hey, if they start going back what they did in the 80s, is there any upside protection on ARMs? Or do you basically say, hey, look, there's a bottom to this, but you're getting an ARM, so you have to understand if they go up, they can go up along with what the market will bear?
Okay. That's a great question. And I am going to address the risk question that you just mentioned. And you're right that there is inherent risk in all investments. I think what I was trying to emphasize there is that there are certain risks that you have the capability to manage or mitigate, and stock or bond market risk, that volatility risk, is the one that I was trying to address there. Right?
Oh, absolutely. Yeah.
Just like you might have interest rate risk, right? So in a bond, if interest rates go up, you're going to have an inverse relationship between the price of the bond and interest rates. So again, there are different types of risks, and the goal is to try to mitigate those various different types of risks in the investment that you've got. You can't wring 100% of the risk out of any real investment.
And if anyone says they can, I would highly recommend thinking twice about investing with them.
I agree. There's always a certain amount of risk. Now, with respect to borrowers and adjustable rate loans, there are different ways that you can also mitigate that risk for the borrower. And borrowers, for example, can do what they call a swap, which is where they're swapping an adjustable rate for a fixed rate. And there are investors on the other side that will buy that kind of swap. That kind of swap becomes very, very expensive in a volatile interest rate environment. So some borrowers will elect to not take that swap. Some lenders may require that kind of swap. Lenders like us, because we're short-term in nature, we don't require that type of swap on these types of loans. And the interest rate exposure or the change exposure or the increase exposure that they have, we're typically underwriting these loans and stressing the interest rate such that, we're not writing it at the rate that we're making that loan. We're writing it at an increment above that, in anticipation that if there were an increase in rates, what would be the impact on their ability to repay that loan, and make their monthly mortgage payments. So again, we're mitigating risk a little bit differently than forcing the borrower to buy a very, very expensive swap.
Yeah. So again, there's no necessarily upside protection, but there are some built-in things where certain lenders might have, say, hey, look, if you get to a certain delta between which we originally underwrote the loan for and what the current market is deeming to be the market for your loan, we're going to require that because we know from how we underwrote it, you're not going to be able to afford it if it keeps going back up, and it's going to be painful, but it's what we're going to do. So that's interesting. I never really, I would have, it's nothing I ever really thought about before, and certainly I always love to learn new things every day, but I never realized that there would be swaps baked into the underlying loan agreement for an adjustable rate. I just kind of I didn't think adjustable rates were very long term, and typically they aren't. You're not amortizing a 30-year adjustable rate, but to have something baked in where it can help to protect the investor like that on both ends of it. I didn't realize there was necessarily a bottom that people would build in, and certainly something to mitigate the top, more for the investor side, not the the underlying borrower side, but certainly very interesting to look at.
Yeah, and oftentimes there's also a pretty decent differential between the rate on a permanent loan and the rate on a bridge loan or a short-term loan. That could be a couple of 100 basis points. So, let's say I'm writing the loan at that 10% rate on a bridge loan, but let's say the market is now 7%. The borrower has the flexibility to go ahead and refinance us out into that longer term, cheaper financing as well. So, even though there might be an adjustment, the borrower does have those other options. And when you think about it for a minute and you think about, again, that equity cushion that the borrower has,
Mm-hmm.
that equity cushion not only protects us as a lender, but it gives them the room, if you will, to refinance that property with another lender because there is equity in the property, as opposed to being over your skis and not having the equity, and you've got this interest rate issue that you've got to deal with. What are your options? Well, your option might be to sell at a loss at that point, as opposed to being able to refinance and fight another day as the market improves.
Yeah, absolutely. And especially from the standpoint of the original lender on something, it's, the borrower is not necessarily beholden to borrow from one person in perpetuity. And especially if your loan product is designed in the short term, well, there's the idea to either sell or refinance out of it. Well, how are you going to set them up for success? Because you want them to refi out of it. That's how you get your capital back into it. Or if they want to sell it, you want to get that payoff of the loan, however that comes back in. So how do you set the borrower up for success? Well, one, it protects you, but two, it makes it more attractive to other lenders. It's really never kind of something I had thought about in that instance. I always kind of think about the underlying security from the investor side, not really how it affects it downstream, but really they're correlated. That is baked in security to it. It's baked in safety nets by saying, hey, look, I want to make sure this person can go out and do something outside of the walls of our garden, because that's how this whole thing works. It's not, just me writing another loan, especially if you don't write those kind of loans.
Exactly. And that comes full circle to one of the comments I made a little bit earlier, where we look at these loans at different points in time. And if you recall, what I said was, that point in time where they're going out and they're getting that takeout financing. We want to make sure that we're underwriting to that exit so that the borrower does have the capability to do that and will be successful in their use of our capital, right? So, when you're doing your lending, it's really kind of a win-win that you're trying to create, right? You want to make sure that you're getting a good return for your investors, a nice risk-adjusted return for the investors, but at the same time, you want to make sure that the borrower is going to be able to work their plan, right? And there's viability to their use of our capital and how they're going to repay us. So, when we look at these things, we look at it from a bunch of different angles, and I think you did a good job of covering a lot of those today.
Yeah, and again, it really kind of, it's you can invest with a, you don't have to, it doesn't have to be a steely fish. You can have some compassion baked in there, but it has to make financial sense. But some of those things are very interesting points to make of saying, hey, look, I want to set these people up for success, because not only does it help me get covered, but also helps, them do what they're trying to do. And in a roundabout way, coming full circle, that helps me too. So figure out what helps the most amount of things. And again, you'll probably be more successful than you aren't, whether that be in life or investing. I think that's kind of a good place to end off on it. So Don, again, I really do appreciate it. I could talk for hours to someone like you. I love digging into the nuts and bolts of this, and especially with someone with the pedigree in the investment world that you've had. Thank you for taking some of your time, because certainly is one of our most precious assets, because no matter how well we invest or how much security we bake in, it's one thing we can't make anymore of. So thank you very much for being with us today. If you wouldn't mind, how can people get in touch with you if they're interested in learning more of what you have to offer, and especially if they might be interested in potentially becoming an investor, how can they reach you?
Sure. There's a couple of ways that they can contact us. The first one would be by phone. And our telephone number is 866-575-5070. Again, 866-575-5070. They can also email me, and my email address is first initial, last name, so D Pelgrim, Pelgrim, at Wilshire, WILSHIRE, F as in finance, P as in partners.com. So dpelgrim at wilshirefp.com. And they can also go on our website at wilshirefp.com. And there's a lot of information about trusted investing and fund investing, private credit, so on and so forth. So a couple of ways that they can contact us. And if they're interested in even receiving some information on this, happy to send that to them as well.
Fantastic. Well, Don, thank you so much for being with us again. This has been the Alternative Investing Advantage podcast. My name is Alex Perny, and have a nice day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.